Let's start off with the Nairobi Securities Exchange. I'm sure every single time you've come here in the last, 5-6 weeks, I've been asking you about the NSE 20 share index hitting 4,000. It appears maybe I'm too optimistic.
I wouldn't say that. The inflation numbers are on that side. I mean, they point towards a movement, increased valuation, improved valuations in the stock market. So we expect that to, we expect that if you look at the trend, ever since the interest rate started taking a downward trend, it's been always positive. The correlation has been terrific, or the negative correlation for that matter.
Right.
And we expect, and that's one of the reasons is, inflation has been brought under control. The rate at which the CPI is growing is under check. And therefore, interest rates being demanded by investors or required returns are being demanded by investors is a bit lower. So they're willing to take now higher valuations of stock going forward. And therefore, on that score, it becomes a seller's market as we move on. And therefore, at some point we'll break the 4,000 mark.
A seller's market indeed. Right now, profit taking, especially yesterday, though 60% of trades were foreigners, but both the equity turnover and the 20 share index also eased marginally again.
No, well, again, that's just noise. You expect going forward. I mean, nothing grows in a straight line. So you expect a bit of profit taking every now and then on rallies. But the general trend remains the same, and the underlying driver remains potent.
Tell me about the Safaricom reading, switching off just under 700,000 fake mobile phones off its network. Is that any serious revenue hit?
Definitely there'll be an effect, definitely. We hope that the earlier, they raised the call rates earlier on in October, worked fantastically for them. So this was supposed to be their first full year of revenues on the basis of the new rate.
Right.
But now we've got this coming in, so you can expect it will balance out. So yes, revenues might fall back a bit. We're also watching another. There's still the issue of the
mobile termination rate, and if that comes down and a new price war begins, then Safaricom perhaps is the biggest one that will be affected by that. Possibly.
But there's also one thing we learned from was it August last year?
Yes.
The elasticities are still in Safaricom's favor. So even if the termination rates are cut, and maybe they have to slightly reduce their prices, they may opt not to reduce it so much, and in so doing, the revenues will not be as badly hit as we would have expected them to had without the episode of August last year. So all in all, yes, they'll take a hit. The question is just how big a hit.
Okay, Kenya Airways, it went ex-div late last week. Everybody is expecting the first half of 2013 results to be terrible because of this retrenchment costs, and just the cost of retrenchment is going to be significant, but also it's trying to expand. Yeah,
well, and of course expansion. You talk about lower load factors.
Yes.
Because you don't just rush in and expect full occupancy. So yes, they're going to go through some testing times, I suspect, and oil prices are also don't look pretty. There's been a bit of volatility, downward pressure on oil prices simply because of recessionary fears. But again, QE3 boosted commodity prices across the board. So I'm not too sure. I think most investors will take a wait and see approach to KQ.
All right. Standard Chartered launching its rights issue this morning. If you had a crystal ball, how do you think this plays out?
Well, for most investors, banking
Yes.
stocks are basically investors like banking stocks. So generally, I think they price the rights well. We expect oversubscription, just much the same way Diamond Trust did. Standard Chartered has always delivered high returns on equity,
right.
So we expect that to go on too in the future. So for me, I guess I expect full subscription. and actually oversubscription on that score.
I need to move on to a different aspect of it, away from the markets, which is the members of parliament once again trying to control interest rates. This, of course, might affect the counters like Standard Chartered, but the bigger problem is, can members of parliament legally control interest rates? They're trying to sneak it in almost through the back. It's an amendment to the finance bill that says all government funds for the youth, for SMEs, for women must be channeled through state-owned banks or banks where the government has some stake.
It's very interesting, and then of course in so doing, my bigger concern actually is what it means for the economy, what the underlying philosophy is, because you're saying that you don't want banks to disburse the loans economically. You want them to disburse it on the basis of need. Which necessarily probably means that some people will not be able to pay, and who
yes.
takes the hit for that? And it's a taxpayer at the end of the day. So for me, it sounds lovely the way it's being put forward.
The heart is in the right place.
But at the end of the day, it will end up destroying, because the problem with joking around with the interest rates is at some point you find yourself in a position where you're consuming capital without knowing. Because you're holding interest rates at uneconomically low rates, and of course the unfortunate thing is somebody pointed out that for all the years of poverty alleviating programs, poverty doesn't seem to have taken a hit. Perhaps it's just the mindset, maybe it's underlying philosophy, incentives and whatnot. So such things end up being wealth destroying policies, and for that I would urge them to think the matter a little bit more.